right, now we're going to start looking a little more in detail about some of the business items you can deduct when you're self-employed or have a business. And the first one we're going to talk about is inventory. So one of the things I like to point about inventory and cost of goods sold especially is this is often your biggest deduction on your tax return if you're selling products. Let's take a look here. This is from Walmart. This is their actual data. You can find information like this on publicly traded companies all over the internet. And so this is for Walmart for their 3 years ending January 31st. They have a fiscal year. And let's look at their cost of sales. So this is their cost of goods sold, $373,000, but their numbers are in millions. So that means we got to add 6 zeros behind here. And that makes their cost of goods sold number $373 billion. Walmart's cost of goods sold is 75% of their net sales. And that kind of makes sense because that's all they do is they sell products and they try to sell at very low price. So it's not surprising that their cost of goods sold is roughly 75%. And so that means of every dollar they spend, 75 cents of it went to buy that product. And so that only leaves them 25 cents left over to pay their employees, to pay their building upkeep and all that other stuff. But obviously they do it by volume. They have a lot of revenue. So even after they deduct 75% of their costs from their revenues, they still have enough left over to pay all the other things they have. And then they still have money left over to make a profit. So the main thing I wanted you to know is cost of goods sold is often a very large number for people who are selling or producing goods. For me, as a service industry, my cost of goods sold is zero because I don't produce anything or buy anything to resell like Walmart does. And so it's zero. But if you are a producer or a reseller, cost of goods sold is going to be a big number for you. So let's start talking about how to calculate your cost of goods sold. As we briefly touched about a while ago, we have this formula where we take our beginning inventory, we add in our purchases, labor costs, and other inventory costs. We minus our ending inventory, and that equals our cost of goods sold. We cannot deduct anything we've put into inventory until we sold it. I mean, it's by definition, cost of goods sold. Not cost of goods in your inventory, cost of goods sold, because that's what we're going to deduct from your revenue. So this is the form. It says draft. Don't worry about it. It's looked like this for many, many years now. We start with our inventory at the beginning of the year, add in your purchases, labor, other costs to equal your total amounts you've paid in for inventory, subtract your ending end of the year inventory, and that's going to equal your cost of goods sold. Yeah, one of the hard things here is you've got to have this inventory at the end of the year. Purchases is easy. Anything you've paid for labor or materials or purchases, that's easy because we are going to see that in like the checking account. When we reconcile and prepare the financials, those numbers are already in there. What we don't know is how much did they have on hand at the end of the year, and that can become a problem. What we don't know is we don't know how much they're going to have on hand at the end of the year. And that can become a problem because they might be in my office on April 1st trying to get their taxes done. And I'm going to say, well, what was your inventory at the end of the year? Well, by now it's 4 months ago, and they may not have any idea how much inventory they had on at hand at the end of the year. And so they're going to have to do their best to estimate it. Bigger companies will actually take an inventory. I'm sure you've seen people running around Walmart or bigger stores where they have this weird machine strapped to their hip and they're just walking around the aisles, just punching those buttons like a madman. That's what they're doing. They're taking inventory. Companies that require an audit will have inventory people come in. One of my first jobs was an auditor, and we audited Grayson County College. And so we would come in at the start of their fiscal year. I believe their fiscal year is October 1. We would come in on September 30th or October 1, and we would watch the people doing inventory to make sure they're counting it right. And we would double check, not because we didn't trust them, but that's part of it. What an auditor does is they get a level of confidence that the counts are right. So I would say, how many of these math books did you count? And they would say, well, I counted 50 of them. And then I would go count them to make sure I got 50. And that gave me some level of confidence that they had the same amount. It's not a lot of fun counting math books at the bookstore on October 1st every year. So this is what your cost of goods sold looks like. Inventory. This one is where it starts getting tricky because there's 4 methods to value inventory. Uh, it's not always as easy as just to add in what you pay for it. If you just buy one product and you buy it from the same supplier and that supplier never changes the price, then some of this is not as important. But what happens when you buy those products and that price is changing every day? Think about gasoline. The price of gas goes up and down, almost every day. So when the convenience store buys 1,000 gallons of gas today at $1.50, and tomorrow it's $1.51, and then the next day it's down to $1.49, how do we value the year ending inventory? And so that's what we're going to look at. All right, so the first 2 methods we're going to look at are called LIFO and FIFO, and these are the most commonly used ones out there in the marketplace. LIFO stands for last in, first out, and FIFO stands for first in, first out. And so this takes a little bit of thinking to comprehend here. On last in, that means the last item I bought is the first one that's going to be sold. And then the other one is first in, is going to be the first item I bought is the first one going to be sold. So the way I like to look at it is at a grocery store. When you go to the grocery store and buy that gallon of milk, do you look at the date, the expiration date, to see if you're getting one that is going to expire further on down the line? And the reason we have to do that is because the grocery store, when they stock it, they put the oldest stuff up front and the newer stuff in the back because they want you to buy their milk on FIFO. The first one they bought is the first one out. So they might have bought some milk on Monday and now it's Thursday. If they still have some of that Monday milk left over, they want it to go out today, but they may have also bought some milk on Wednesday, and that's the milk you want on Thursday because you want the freshest milk in there. And so you want to buy milk LIFO. You want the last one that they just bought to be the one you're picking up right now, last in, first out. So that's kind of easy to understand. A lot of people get confused with LIFO. FIFO makes sense because Walmart will buy some inventory, they'll put it in their warehouse like this and wait for you to buy everything that's on the shelf, and then they'll come get some more and go stick it out on the shelf. And so they're doing FIFO. The first items they bought are the first ones that go on the shelf, and then the last items they bought are still waiting to go out on the shelf. LIFO takes a little bit more comprehension, trying to understand why would anybody use LIFO. One of the easier ones to comprehend is imagine a big pile of coal. You know how they have those machines that dump the coal on the top and it just forms a big pile of coal. Well, you can't get down to the center of it where the pile first started to get that first piece of coal out of there to sell it first. You have to do it on a LIFO. You got to take the last little bit that just fell on top of the pile and get rid of it first. And so they're doing it LIFO. There are a couple other methods. The specific identification is pretty self-explanatory. This is where you can identify which asset you're solding. This is generally used for bigger assets, like houses. It's very easy for a home builder who builds 4 or 5 houses a year to specifically identify which items are in his inventory. And then weighted average. This is often used when you buy a lot of stuff and it's very hard to identify the specific items. And so you'll just do some weighted averaging, and we'll look at some examples of all these here in just a second. So don't get too bogged down if you don't understand it. Most people do the FIFO, and so it's pretty self-explanatory on how to do FIFO. So let's look at some examples of FIFO. This is where it's first in, first out. So here's an example of where you bought some items at different prices during the year. So in January, you bought 100 items at $4 each. 200 items at $5 each, and then 200 items at $6 each. So you can see where you have different values for the items you purchased, and then you have some left over. So you bought 500, 100, 200, and 200. You bought 500, you sold 400, and now we need to know how much of that ending inventory you have left over and what the value of it is. We can't just use any one number of these because we got to identify what we're using. So we're using FIFO in this example. First in, first out. So we're going to assume 0 beginning of the year inventory just to make life a little easier on us. So the first ones in are the first ones we sold. So we sold 400 of them. So we sold all of the January purchases because we're using the first ones. These are the first ones we bought. So these are the first ones we sell. Then we sold all of the June purchases. Remember, we sold 400 units. So we've got 300 now. So we still need 100. So we're going to sell 100 of the November purchases. And then we're going to add all this up and find out our cost of goods sold was $2,000 because we sold all of these, we sold all of these, and we can see we're just doing the simple math across. We bought 200 at $5 each and we sold them, so it's 200 times $5,000. This is how we get our cost of goods sold. And then what's remaining, we would have 100 remaining at $6 each because again, we're using FIFO, so we're using these and we use these, and we only used half of these, so we got 100 left, and we'll value them at $6 each. Okay, so let's look at how we apply this in our formula. Remember our formula, beginning plus purchases minus ending inventory equals our cost of goods sold. Just to refresh on what we did, we already know what our amount was from the previous slide. So our purchases were $2,600 using our data here. Our ending inventory, we knew we had just 100 left over from the November purchase because we're doing FIFO, so we had 100 left over here. And then our cost of goods sold, as we just calculated, was $2,000. And so then we'll just put it into our formula and you can see how it works out. Our cost of goods sold is $2,000. So now let's look at a LIFO example, last in, first out. We're going to use the same data so we can compare the two. So we sold all the November purchases because we're doing the last ones we bought are the first ones we sold. So we sold all the November purchases and we sold all the June purchases. So now we haven't sold any of the January ones because we only sold 400. We've added up 400, so we still have all the January ones left over. So now our cost of goods sold is $2,200. So now you might be saying, why does this matter? And if you've listened to me over the first 3 chapters, you probably already know why this matters. Money. Remember, it's often your biggest deduction. So we're just using a small example here. And so our difference is only $200. But, you know, if we have $3,000 in sales, we're going to subtract our cost of goods sold. So you can see we've come up with 2 different taxable income numbers using 2 different inventory methods. Both of these are legal. Both of these are acceptable to use. So we're adjusting. Now, in this case, we only have a $200 difference. If we multiply that by roughly 30%, you can see we're having a $60 difference. Not a big deal. But what if these numbers were like Walmart's numbers, where these values were in millions? So now we have a $200 million difference. Multiply that by 30%, and now we're talking a pretty big number. So you can see why companies want to switch it around the best they can. Usually once you pick a method, you got to stick with the method. So this will affect your tax bill. That's why inventory valuation matters. Oh yeah, don't even get me started on property taxes. So this helps understand why you often see in late December companies having these end of year tax sales because of property taxes. So this is a whole nother tax. This is kind of outside the realm of income tax, but let's digress for just a second here. You have to pay property taxes, and these are local taxes. The federal government doesn't levy property taxes. Your local city, state, county, school district, community college levels property taxes. So Grayson County College levels a property tax on my property, and I have to pay it. And so sometimes inventory is counted as part of your property. And in Texas, we have what's called business personal property. So I have to pay property taxes on my desks and my computers, my copiers, my printers, everything. I have to pay tax every year on goods that I've already bought and paid tax on. I still have to pay in property taxes to Denison ISD, the Grayson County College, the City of Denison, and Grayson County Community College. So every year I give Grayson County Community College a few dollars because I have a copier that they're taxing me on. So that is why a lot of companies will try to sell a lot of their inventory so that when they have to do that December 31st inventory, not only will it help their cost of goods sold number, it'll also help reduce their property tax number. So that was a brief explanation of inventory and how we use inventory and calculate the numbers that are important to inventory. So let's now move on to talking about transportation, another big one that a lot of clients worry about.